This is our Forex blog for August 18th, 2014. Before I show our currency indexes and how to use it to manually trade, I'd like to show how our signals are doing. Here is the euro dollar from today. And again, the real key to trading is just having small losses, big wins. In this case, we risk this amount and we make this amount. It's significantly bigger than what the risk is. Let's go to the next case, the euro yen. Today we have a very tiny loss. Then we risk this amount, we make this amount, which is about the same amount as the risk, and then we take a short here and we make 1.5 times more profit than what the risk is. So that's two currencies today that both made more than they lost. Here's the dollar Swiss today. It gives a trade right here. This is the risk and this is what the reward is. And then it got short right here and the market's been dead all day. Now this illustrates one of the things I've been working on, and that is to change our exit code and make it more intelligent. Let me take away the original stops and showcase one of the new stop code I'm working on. As you can see, the small win right here turned into a huge win. And another instance of this is in the euro dollar. Let me scroll back and showcase a trade right here that with the new stop code I'm working on, this was initial risk and it generated this much profit. Significantly more profit than what the risk is. Let me put the original stop code back in there. You know, there's a lot of things I'm doing to improve our trading system, finding new entry methods, improving old ones, and also working on the exits to make them more intelligent. Again, take a note here. This got in here, went up a little bit, came down, almost stopped us out, then shot up and we made money. The original exit code got in right here and made a very tiny amount of profit. It made this much profit instead of, you know, this much profit. Now, obviously, nothing is perfect. When you have a little wider stop under some circumstances, it's going to frequently lose maybe 2 or 3 pips more or make 2 or 3 pips less than what the old method did. But it also keeps you into these big wins like this. Again, like the dollar Swiss today, where it had a very tiny win. It got in right here at 37, got stopped out at 40. 3 pips profit. Nothing to get excited about. Versus the new method I'm working on, which I hope to release in the next week to 10 days. Got in right here and stayed in all the way up here. Now again, notice the exits on this. In this case, it got out here and here. In both of these instances, it made maybe 1 or 2 pips less than it would have with the old method. But it also allows us to stay into these big wins. That the entries were so good. The 626 I think I'm up to entry methods I have are so good and so powerful and so strict that until the market makes at least a 2-bar pullback, I don't want to have a tight stop, and that's the difference between the two. You can see this one kind of went up a couple bars, down, up, and then it went down 2. Whenever we have a 2-bar counter trend move, then I decide to tighten the stop, and it has a little wider stop to begin with. And so that allows us to frequently catch significantly more pips than the old method. Here is the pound yen today. And this is the old exit method. It doesn't really make any difference in this case because there really was no 2 bars in a row down until right here. In this trade right here, it made this much. The new stop method would have got out of this trade right here, 2 or 3 pips less, not a big deal. And again, this trade right here, very small win, but no loss. And here's a pretty dead currency, the pound dollar. You can see that even in a very, weird situation where it gapped up, pulled back a little bit. It's very choppy. It got into this trade, and it pretty much broke even on the trade. You know, when the market really didn't have any kind of volatility or any kind of decent trend. So that being shown, let's look at our currency indexes. These let you see visually what each individual currency is doing. And you can see a lot. You can see, for instance, the dollar has started the day off trending up very strongly. It's underneath Friday's most actively traded price of the day. Pulls back, but it can't break the previous day's low. And then when it breaks out right here at 10 o'clock, it's very likely to go up. The monthly trend is still up. The weekly trend shifts up at that point. And you can see the dollar or the euro here, it's not able to make a higher high, and it's in a nice little wedge pattern right here, and it breaks down coming up to 10 o'clock when the dollar looks like it's about to break out. So at 10 o'clock the euro dollar is very likely to go down. You have a very weak euro, and a dollar is likely to go up. And so if you look at the euro dollar today, actually, let me find this exact time here. It's actually closer to 9:10. Let's bring up the euro dollar again. And here is 9:26. It's somewhere between this bar and this bar. This currency is likely to go down. And our signal already had it short about an hour and a half earlier. But nonetheless, if you were just watching that currency, you would go short right here with a very tight stop, and you can see it made significantly more than what the risk is. You know, 2 or 3 times more profit than what the risk is by using our currency indexes. Again, the euro's weak. Let's look and compare it against the pound. That's strong. 9 o'clock, you can sell the euro pound. It's very likely to go down and make you money. And take a look at this at 9 o'clock. Here's the low of the day so far. 9 o'clock, we're looking for a sell. Has a little bit of a pullback. You can see if you drew your fibs on here, this is way less than the 50% fib level, where you could put your stop, have a very tight stop. And this just goes down, goes sideways. You put your stop above the high, and it goes down again. And most of the time, once it makes a one-wave move, you can draw your fibs on there, and usually the 1.618 fib target is about the maximum you're going to make. So you can take this trade right here with this much risk, and you know, when it comes down to the 1.618, it's a pretty decent place to get out. It only moved 2 more pips, 3 more pips than that, and you have about 5 times more profit than what your risk is. And again, that's the key to trading. Small losses, big wins. It's not rocket science. Let's see if any of their currencies are strong. Here the Australian shot up earlier in the day and went sideways. The daily, the weekly and monthly trend is up. So you have a weak euro, strong Australian, and so the euro Aussie is likely to fall, coming up to 9 o'clock, a little bit after. And guess what? Here's the low. You know about that at 9 o'clock. You wait about 15 to 30 minutes. Breaks down right here. You go short. And this just kind of falls down and goes kind of slightly sideways with a downward slant. And, you know, you can draw your fibs on that wave to get an idea. Here's your first fib target, second fib target. And when a little bit below that, you can draw your fib targets on there. Let me just do it to see. Very rarely do markets go below the 2.0 level. But however you drew that on there, this is a pretty high probability place. Remember, you sold this right here with your stop right here. So this is your risk. And, you know, it starts to go down. If you wanted to exit half your trade here and your other half at the 1.618, your average profit would be half of that difference, which would be right around here. And even if you did that, your profit is about 5 times more than what your risk is. And so you don't have to be right too often in order to make money trading when you have that kind of accuracy.